Hello, welcome to the UTI Swatantra series powered by ET Now. We're in the beautiful city of Bangalore. The idea with today's episode is to help us understand how we can use SIPs to possibly tackle every financial goal that we have in the book. And in order to answer questions that our audience has this afternoon, I have with me three wonderful panelists, all of them individually successful in helping people with their money. We have Anurag Bragodia, is the founder and director of Nesture. Nitesh Shah is the co-founder of Credence. And Mrin Agarwal is the co-founder of Womantara. Thank you all for coming in. Before we open the floor for questions from the audience, and I know there'll be a fair amount, we tend to sort of get to mutual funds last as investors. We start off normally with just the tax saving. And the tax saving in our country tends to be either PPF or an insurance policy. But Min, take us to just saving tax. Can I use a mutual fund to simply save tax if currently that's my only goal right now?
Absolutely. You could use the ELSS schemes, which work really well, because firstly, they only have a 3-year lock-in, but that's not to say that you invest only for 3 years.
So, okay, explain to us what an ELSS scheme is.
So it's an equity-linked saving schemes where you can invest money. There is a lock-in for 3 years, but you certainly need to, you can hold the investment for longer than 3 years as well. The investment would be in a fund which invests into stocks, so it would be into equities. Mm-hmm. It is a good way to save tax other than PPF, I would say, or compared to insurance, I think it's a good way to save tax.
What have been the returns on ELSS over the last, say, 10 years?
If you look at the last 15 years, your ELSS have compounded by nearly 20% per annum. No asset class is good or bad by itself, but the idea is that if you look at the similar period, if you would average returns out of your other instruments which are available, which are namely your provident funds and so on and so forth, the returns in them have been closer to 9%. Yeah. So to that extent, there is a wide difference.
People tend to use ULIPs a lot.
Yeah.
I mean, if you were to compare for me the ELSS as a tax saving mechanism with the insurance policy, where would you plug it? Where would you put it?
So both of them are different in terms of the objectives that they meet, for the simple fact that ULIP gives you an insurance cover along with meeting an investment objective, as against an ELSS, which is going to be a pure investment-led objective investment product. Having said which, there is a unanimous view across financial planners that you've got to separate objectives and have a separate insurance policy by which you can have a simple term plan. Mm-hmm. And look at an ELSS which will give you an investment option across a mutual fund.
Okay, the other options, we talked about the PPF, we talked about comparing it to an insurance policy. The third option is the NPS, which is now from a taxation point of view more attractive than the ELSS. If I were to choose this year, out of the money that I have to put aside for tax between the NPS and the ELSS, how would you help me choose?
So NPS is, with the new government which has brought in the 50,000 extra benefit on the NPS, it has become very popular. And it's not a bad idea, but one has to keep in mind the NPS, the final income is taxable in the hands of the investor. So that is something important. Second thing, what happens in equity, if you invest in say ELSS, which is equity linked savings scheme, one, you can always do it on a monthly basis. I have seen the investors wait till the last March 30th to do their planning and invest that balance amount, right? So you can do one every month, some amount which is like SIP, that is one. But NPS, what happens is, the problem is you can't choose, up to a certain extent only you can choose how much debt equity ratio you want. But if you want to be on the higher equity exposure, you can't choose. Second thing, most of the working people will have EPF, Employee Provident Fund. So already you're investing in EPF, which is a pure debt option. So now you want to average your asset allocation between debt and equity, then the NPS may not be a great idea at that time. Okay. But I'm not saying that NPS is completely wrong. Maybe next budget he may bring it to be exempt, which is, then it may be a much better idea. Today, I'll just give one more thing. People should also look at the Sukanya thing which has come for the girl child. You can invest up to certain amount every year, up to 1 lakh or something. And that is exempt.
If I have a PF deduction, which is compulsory, yes, then does it make sense for me to take any of these other products?
I will not suggest them. Okay. As an advisor, as an investor myself, I will not do it. I will do it because if I suppose having a, just for sake, I have say 10,000 rupees deducted as my EPF in a year, then I'm already in the debt category, which is going to give me 8.5% or whatever the government decide. I'll give you just number. If you have done SIP of in last 15 years of 1,000 rupees in any of the general diversified equity funds, which ELS is also one, you would have in 15 years, you would have put say 9 lakh rupees. And in last 15 years, annualized return would have been somewhere around close to around 18% on that. And the value today would have been around 69 lakh rupees. 9 lakh would have been worth 69 lakh rupees as on date. If you take, go to many of the websites and just see the return, you will see that.
Yeah. Actually, just to put it very, very simply to all our audience members who are here, the simple Sensex over the last 30 years has given an average annualized return of 17%, which means that in the last 30 years, the Sensex has become 100x, 100 times what you invested 30 years ago. There is no other investment available in the market that can give you 100 times, and it's entirely tax-free. And most mutual funds, most equity diversified mutual funds have beaten the Sensex handsomely through the course of their lives. Anyone has a question? Yes.
Generally, most of the companies launches new schemes in mutual funds, say specialized in infrastructure or banking. But over a period of time, say 3 or 5 years, some schemes would be doing better and some not. So how do we know, or how do we identify which scheme is doing better well in advance?
See, I personally, and this is my personal view, I think we should stay away from thematic funds altogether. They don't make any sense to me whatsoever. Because if you're going to do infrastructure, your equity diversified fund is already investing in infrastructure. And you've got a fund manager there whose job it is to decide that, listen, I'm going to go bullish on infrastructure right now, or I'm going to pull back on infrastructure. So these funds of banking and pharma and infra, they tend to be very cyclical. And then as a result, as an investor, you have to constantly watch it and decide when to get in and when to get out, which defeats the purpose of using a mutual fund.
Yeah.
First, you should avoid thematic unless you are a savvy investor. You know, if you're a very, very savvy investor, then you please go ahead and do it. Otherwise, don't do thematic fund.
Yeah.
If you believe in,
if you're that savvy an investor, then I might as
And
well
if you
just
have
be
the
buying
time
stocks,
to,
right?
if you have the time to track these funds to enter and exit.
Any more questions to you? Yes, the gentleman in the front row.
I'm just basically putting my money into things where I don't lose money. So the secondary income should be there. So whether it is 9 or 20, I don't know. I should not lose money. So is there any option available in this huge market of mutual funds where I just put in money and forget it?
I'll just put a point. You think you are putting in the safe money, right? So in last 30 years, average inflation has been what? 7.5%, 8%.
Yeah.
And your FD return would have been, say, 10% average, because in past you were getting higher return. But what is your real interest? What is your real income? 3%. And post-tax maybe 0. So are you in the safe zone? So you have to question that. And second thing, if you don't have time, I'll definitely suggest take an advisor's opinion. Take a good advisor and work with him.
Okay, let's take some questions from the back.
Why do we have n number of mutual funds keep on coming, like NFOs, and hundreds of funds are keep on coming? How do we, as an end investor, can choose that actually?
That's a very good question, sir. I completely agree with you. There is absolutely no benefit whatsoever from investing in the NFO of a mutual fund, right?
Yes.
Do you want to take this?
Yes, agree.
Avoid it.
There's no benefit whatsoever. So technically, I should avoid all launches?
Yes.
Until unless there is a very differentiated product which hasn't come before, which is unlikely.
Is it possible, with the thousands of funds we have in our market, for someone to come up with a product that does not exist already?
No, so let me give you an example. In the last few years, we have seen fund of funds on the international side. So that was the time where it was for the first time you had international investing as an option from mutual funds, right, which was not available before. Let's hope that the REIT also becomes a reality where for as little as 2 lakh rupees, people would be able to invest into real estate products. So as long as you have a big category differentiator like that, it's completely advisable to avoid any new fund offers.
Is it possible for me to approach mutual funds simply from, in a manner of elimination, where if I first just eliminate all of the thematic and the sector funds, if I then eliminate any fund that is not at least 3 years old in the market, so I don't have a track record. How do I know what the track record is if it's not been around for 3 years? So like this, if I keep eliminating anything that does not have, say, a 5-star track record over the last 10 years, then I will come down to a smaller list of funds that I can actually use. Is that something, is that a format?
Definitely. So that's one of the options. First is, let's look at the number of funds. Right? I'm sure most of the investment advisors would agree to the fact that ideally anywhere between 5 to 8 funds is an optimal number of funds that you would hold. Anything larger than that is over diversification, and anything under is under diversification. So to that extent, number of funds should be kept to 5 to 8 in your portfolio. Right? That is point number one. Second, like Faye said, have very, very simple parameters to run an elimination and be left with very, very few funds that you could actually invest into. So having a process of elimination, sticking to fund houses which have demonstrated a track record over a long period of time, where the fund managers have, the attrition, or the fund management team has experience, and that is very, very visible across whatever fund management notes that you would read. I think it's a fairly simple process to go with.
Anyone else? Yeah. Yes, the gentleman from the back.
Now I'm shortly going to retire. Any mutual fund that gives back every month 10,000?
I would first of all recommend to put the money into a debt fund, like maybe a short-term fund, and do a systematic withdrawal plan every month. I'm not sure in terms of if, depends on what is your investment amount to see whether you will get the 10,000 or what will you get, because the returns are obviously not guaranteed. But I would say,
no, but if he were to put his money in a debt fund and do a systematic withdrawal, then he's taking out of his capital every month, right? So if we just were to assume then he has a corpus of money and he would like to generate a monthly income from it, what would be the best way to do that?
So no, but even within the systematic withdrawal plan, where you do have an option where only the returns at the end of every month are actually given back to the investor.
Okay.
So there is an option available where the capital is not touched and only the returns is given back to the investor. So that option is available within the mutual fund space.
Okay. Outside of mutual funds, is there anything you would recommend he uses? Perhaps the senior citizen savings scheme? It's not such a bad idea.
Yeah, but again, the return is very low, right? Okay. And it's taxable. Senior citizen returns are taxable again. So what they have said is very right. You can choose within equity and debt or combination of both and see the tax efficiency. I'll suggest now there are a lot of, within mutual fund, there's a tax efficient way of things have come. You can choose debt and equity combination, but you don't pay tax as a short-term gain because it is still treated as equity. That's a separate topic. But I think your advisor can help you on that. And you can still get almost tax-free return on a monthly basis.
The other important point is, given that you're going to retire, so you're not going to have salary income which is going to be taxable, I'm presuming. Right? So if you're not going to have that, then some of even the conventional instruments like a fixed deposit or the senior citizen savings scheme, up to a certain tax slab, for example, up to let's say 2.5 or 3 lakhs rupees, depending on certain circumstances, that income is going to be tax-free for you. So you will be well advised to use those tax slabs that are available to you post your retirement as well.
All right, let's take another question. Yes.
I have two questions. One is this small cap fund, mid cap funds, and then the infrastructure funds. Should we go for that, or we should go only for diversified funds?
See, small and mid cap has, if you see the history, they have done on an average done better, but at the volatility is very high. So if you have a short period of time, then you may be, if a market tanks by 10%, the mid cap can tank as high as 20% also, right? So you have to see the horizon, and you can have a mix. Again, it's it depends upon how much you have invested in the past, what is your risk ability. Core should be your diversified large cap funds, and you can have some satellite funds like small cap or mid cap as 5%, 10% in your portfolio to just give the kick up. But you at this same time, if the downside happens, you don't lose much.
Second question is whether how much maximum you can invest out of our, suppose if you have some 50 lakhs, how much maximum percentage you can invest in one fund, that means one mutual fund company.
Sure, so thumb rule typically is that you generally don't exceed 15% of your corpus into one fund. Generally as advisors we would say that if you're first time investors, then you cap it at between 10 to 15% into one fund per se. It's also important for you to know that it's just not the number of funds, but what type of funds are you investing. So if you're going to put 10% in 10 funds, but all 10 of them are going to be large cap funds, there's going to be a large overlap amongst the investment that you make. So it's important to cap number of funds. It's important to also diversify from a strategy standpoint if they are meeting different objectives and not the same objective that you have.
This is Hemendra. I have one question. What is the difference in closed-end fund and open-end fund? And what is the benefit to invest in closed-end fund over the open-ended fund?
The difference in a closed-ended and open-ended, so closed-ended fund have a fixed period where your money gets logged in for that period. Open-ended fund, you could remove your money at any point in time, so that's the basic difference. Well, one of the advantages that are said about closed-ended funds is that it allows the fund manager to take more long-term bets because the money is logged in for 3 years. But in reality, I have also not found too much of difference, and I would prefer to take an open-ended fund because of the fact that I can remove the money at any point in time.
Is there anyone else who has a question? Yes.
Is there any mutual fund investment which will take care of the investor's risk? Because they say there is some amount of return which will be definite. Now, taking care of that risk, anything over and above, the risk matter, the minimum return that they promise, can there be any investment which will take care of that over and above additional risk and give us the minimum return that they have promised?
No mutual fund, whether it is equity or debt, is allowed to promise you a return at all. Even in the case of debt, where the mutual fund is fairly sure about what kind of return it can make, it is forbidden by SEBI to offer you a guarantee of any sort. So if someone is coming to you with a mutual fund saying, this is how much money you will make for sure, please send that person home because he's cheating you out of your money. So nobody can offer you a guarantee, sir. So if somebody offered you a guarantee, that's a case of mis-selling, and that was advice that you technically should not have taken.
Is SEBI having any rules at your mutual funds?
In fact, if you ask anybody in the mutual fund industry, they'll tell you that SEBI has too many rules about mutual funds.
It's highly regulated. Every day they have to report whether debt, equity, every day they have to value it. So SEBI reporting and is one of the toughest regulator in the entire world.
To an extent where every single mutual fund has something called as a NAV, which is your net asset value of a mutual fund. It's declared on a daily basis. So 9:30, 10 o'clock in the night, you can actually see it online for that particular day. So there are very seldom you'll find investment options where on a daily basis you can actually see exactly what the value of your investment is.
And to add to that, India is one of the few countries where you can actually see the portfolios also declared on a monthly basis. In most developed countries, you would not see portfolios declared on a monthly basis.
Last year, there was a talk to make mutual fund industry more attractive. They'll be issuing bonus units, any such kind of fund. Any fund is doing very good, like that, bonus units will be issued, like that something. After that, it died down. Any such plans are available in future?
There's a misconception of people here. I'd like to clarify that. So when let's assume you have 100 units in a mutual fund and its value is say 10 lakh today. If I give you a bonus of another 100 units, your value will be still 10 lakh. The per unit value comes down by half. So you don't get any extra bonus or something in the thing. So don't get flared about by dividends payment or getting a bonus, because dividend also comes out from that NAV which we talked about. So if NAV is 100, if I give you 10 rupees dividend tomorrow, your value will come down by 10 rupees. So you're not making 10 plus 100. So
actually, Anurag, since we're on it, take us through dividend and growth, because I know that's a lot of that's a question a lot of viewers have. I finally picked my mutual fund. Now I have dividend reinvest, and growth, and it's all very confusing. What should I choose?
My personal opinion here, if you are in equity mutual fund, go for growth option, because as I just said that if they pay dividend, your NAV comes down anyway. And also it's a multiple effect. I think that's another thing, compounding effect. If you don't need money, why you want to take out from there? Keep it there.
There's also a tax treatment difference, isn't there? Or there will be soon enough. Whether I opt for the dividend or the dividend reinvest, and I opt for simply the growth option. What is the treatment of tax?
So today on the equity funds, your dividend which are declared by equity mutual funds are tax-free in the hands of investor, and that's irrespective of your taxable incomes or taxable slabs. Your growth options are also tax-free today because long-term capital gains, which is basically holding the same equity mutual fund for more than 12 months, that is also tax-free as it stands today. So just to add to what Anurag said, reinvesting your profits is equally important in the long run. Right? So rebalancing is one portion, but rebalancing your investments and then reinvesting the profits into another investment is equally important.
All right, go ahead.
I just wanted to know whether systematic investment plan is preferred or a one-time investment is preferred typically for.
The SIP is preferred always, is what I would recommend for most people, because it allows you to keep saving money on a regular basis. It allows you to save before spending. It allows you to average out your costs as well, and it allows you not to time the markets as well.
So what if you have some fixed amount already? Should you invest in a mutual fund, or is it advisable to go into a IPO or a open market?
I would not recommend, first of all, to invest in IPOs and in direct stocks, because I think most of us really don't have the expertise to track what's going on. Firstly, you need to know what is your objective for investing that money. So if you're investing, let's say, for your child's education, do I take it that that's what you want to save for? Yeah. You'll have to look at a combination of debt funds and equity funds, right? Depending on when is that goal coming up, like when do you need that money, right?
Let's say 3 years from now, will that be a...
3 years? Yeah. If it's 3 years from now, then you'll have to look at a large portion of it invested into debt funds, because on a 3-year basis, I think equity funds could be quite volatile. So you'll have to look at a larger allocation to debt funds, and there you can do a lump sum.
Perhaps a balanced fund, one balanced fund if I have a 3-year horizon?
Yeah, could be. Balanced fund is the option where they have a debt equity ratios. There are different kind of balanced funds where there's a fixed debt equity almost, 70% equity and 30% debt roughly. And there are other balanced funds which changes with the market changing. They change the equity component. If the market is low, they increase it. If the market is too high, they decrease it as per their formulas. So you can choose that also. But as Min said, if the horizon is 3 years, be more on the debt side, because education is very important. So don't try to make more money there, but protect your money.
You, sir, yes, go ahead.
Okay. My question would be around how the NAV is calculated each day, because the market goes up by 500 points, the NAV is so high. When it goes down 500 points, the NAV is totally different. There is a gap between how the NAV is calculated. Is there a way we can track?
At the macro level, NAV is nothing but just the average value of the stock positions that you hold. So let's say even if you were to be buying 10 stocks, the average value of that is what a net asset value would be, net of expenses. For discussion's sake, let's just forget the expense bit. Now when the market goes up 500 points, let's say the index, you are mentioning to let's say a Sensex for that matter, the underlying companies that the fund manager owns could go up either in the same proportion or higher or lower. And that is what will get reflected in the NAV as well, which is your net asset value as well.
I have a question on SIP investment. Let's say I have a time horizon of 15 to 20 years.
Okay.
And if I have chosen 4 to 5 funds, as you said, maybe small cap and diversified mutual funds. After a year, let's say 2 years, I found that most of the funds are not performing well. And how do I exit and choose other funds?
Do you want to take this, Brent?
I think 1 to 2 years is a time frame that you will have to wait for. But I think more importantly, you'll also have to look at what the fund is holding and what is the reason for this underperformance basically. I mean, getting out is just giving a redemption request and then getting into another fund. Yes. I would say try to hold on for 2 years, look at where the fund has invested and look at what you think those sectors could be doing in that particular fund.
Yeah, so this is also where your advisor comes into play. When after 2 years you're unhappy, this is where you call your advisor and say, listen, I'm unhappy. Why is this fund performing badly? Look at it, tell me what's wrong, tell me why I should stay invested. And he should be able to offer you, he or she should be able to offer you a valid justification. And you should be happy with that justification. That's the advisor's job, the person who suggested those 5 funds to you.
So one last question about advisor. Suppose, do I need to, I usually refer online websites, whatever is available. So which one is better, online advisor or personal advisor?
Real person? I prefer a real person. You have somebody's neck to catch if something goes wrong.
You know, I think the online advice platform works really well for people who understand the basics of mutual funds or the basics of investing, and they really know what they want, okay, in terms of, okay, I know I have to put 50% in equity, and then it's a question of just looking at the funds and choosing funds based on certain parameters, right? But I think if your situation is more complex and there are questions that you're not able to answer, you would certainly need to meet an advisor. For example, a lot of people have questions on tax. A lot of people are not even sure as to what is the amount of money they need to start saving for retirement. Okay?
Unfortunately, we've run out of time. You can send us a question on Twitter if you like, #Swatantra, or join us on our website, www.bswatantra.com. Thank you so much for watching. You've been a wonderful audience. Thank you for joining us.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.